I don't think the 4-year cycle is really functionally relevant anymore. It still, I think, has some kind of mental relevance in that if people expect something, they can kind of be a self-fulfilling prophecy. But I think for the past cycle or two, it's not really mattered. So earlier on, the 4-year cycle was really relevant because you had less coins in the market. You had more coins coming out with each block. Bitcoin now has a supply, like annual percentage supply growth of less than 1%. And the vast majority of kind of, marginal buying and selling of coins, prices are mostly set by how much longer term holders are selling and at what prices versus how much new demand's coming in. That factor is 10 times bigger than how many coins are hitting the market with every block, just because that number is so small now.
Bitcoin investors have spent years building their expectations around one simple idea: the 4-year cycle. Every halving cuts new supply in half, scarcity increases, demand eventually overwhelms sellers, and prices explode higher. It worked before. It became one of the most widely accepted frameworks in all of crypto. But this cycle didn't play out the way many expected. After the 2024 halving, investors anticipated another euphoric move. Historically, the year after a halving has been Bitcoin's strongest period. It was supposed to be the phase where prices accelerate, retail investors flood back into the market, and Bitcoin enters the kind of parabolic rally that has defined previous cycles. Instead, while Bitcoin still achieved impressive gains and eventually reached roughly $126,000, the move fell well short of the extreme targets many analysts had been predicting. Rather than experiencing another explosive run toward the numbers that dominated social media forecasts, Bitcoin spent much of the cycle battling volatility, competing for investor attention, and repeatedly struggling to maintain momentum. So what changed? According to macro analyst Lyn Alden, investors may have been looking at the wrong indicators altogether. While the market remained obsessed with halvings, cycle charts, and historical patterns, a much larger force was quietly shaping Bitcoin's performance behind the scenes. The real story may not be about new supply entering the market, it may be about old supply leaving it. In other words, the biggest battle in Bitcoin right now may not be between bulls and bears. It may be between institutions buying and OGs selling. And according to Alden, that dynamic has become far more important than the halving cycle itself. But before we get into her analysis, make sure you hit the like button, subscribe to the channel, and let us know in the comments, do you think the 4-year cycle is dead, or is Bitcoin simply evolving into something much bigger? Now let's hear what Lyn Alden has to say. Retail traders buy crypto on exchanges. Serious investors think about structure. iTrustCapital's Crypto IRA lets your gains grow without capital gains gutting your profits. Their premium custody holds assets off-exchange with institutional-grade security, and their treasury accounts give businesses and trusts crypto exposure with proper reporting and compliance. Same assets, completely different level of protection, 24/7 trading, no monthly fees, real U.S. customer support, $100 bonus when you fund through the link below. Price matters. How you hold it matters more.
Well, the short answer is, Bitcoin has this volatile track record. It has higher highs and higher lows along the way, but it has these really big washouts. Historically, it's pretty correlated with liquidity. At least 83% of the time, it's correlated with kind of overall kind of macro liquidity. About 17% of the time, it's not. Right now, it's kind of in a period where it's not. In addition, for a long time, Bitcoin was the fastest horse, really, that you could invest in. It was kind of the best performer. And the rise of AI companies has challenged that because there are other places to put capital that can give you a 10x return, or that have given investors a 10x return. And so people say, well, why would I hold Bitcoin when I can, hold a chip stock or something like that? And of course, the advantage of Bitcoin is that it gives you what a stock does not, which is that you can self-custody it like gold. And with advantages or disadvantages versus gold. Gold's obviously got the longer term track record. The challenge, of course, is that it's not as mobile without relying on custody. I use the example that I live part of the year in the U.S. I live part of the year in Egypt. If I have self-custodial gold, there's going to be a time where I travel and it's out of my personal possession at that point. Whereas you can set up Bitcoin in a multi-signature way so that if you travel the world, you still have ways to access self-custodial value that you can send around. And so there is a use case there. But I think from a price standpoint, from a pure investor standpoint of just buying it and holding it and not really using it, when people can buy, Bitcoin treasury companies, they can buy Bitcoin ETFs, they can buy Bitcoin on exchange. They're comparing that price action to AI, and I think AI, the rise of AI is kind of sucking a lot of the attention out of it. Now, eventually, when that stops rising, like we talked before, when that kind of just say trend sideways for a period of time, and Bitcoin is washed out, I think it can reattract some of that capital. The other big factor is that I've been bearish on the broad crypto space for many years. I've been bullish on Bitcoin and stablecoins, but bearish on virtually every other project in the space. And a lot of that is really shaking out now. There's right now just kind of the overall use case of broad crypto is very stagnant. I think a lot of investors are kind of realizing there's no there. Um, and a lot of that capital is intertwined. So as capital gets out of that broad crypto space, it naturally, in the near term, hurts Bitcoin as well. But I think when the dust kind of shakes out, Bitcoin and stablecoins, there's actually a there, and it's natural for kind of some of the air to come out of that broader crypto space, and it's healthy in the long run, even though it can be kind of painful in the near term. I don't think the 4-year cycle is really functionally relevant anymore. It still, I think, has some kind of mental relevance in that if people expect something, they can kind of be a self-fulfilling prophecy. But I think for the past cycle or two, it's not really mattered. So earlier on, the 4-year cycle was really relevant because you had less coins in the market, you had more coins coming out with each block, and so a halving. That's what happens every 4 years, roughly a halving. So there's just half as many coins being introduced into the market per block. That really matters. If you have a monetary network with say a 12% inflation rate and it gets cut to 6%, that's a really big deal. But after multiple halvings, Bitcoin now has a supply, like annual percentage supply growth of less than 1%. And the vast majority of kind of marginal buying and selling of coins, prices are mostly set by how much longer term holders are selling and at what prices versus how much new demand's coming in. That factor is 10 times bigger than how many coins are hitting the market with every block, just because that number is so small now. So when you have say a 0.8% annual supply growth, and you eventually have a halving, you cut that down to 0.4%. That's less relevant than is 5% of long-term held coins coming to market because the owners are concentrated and they want to kind of cash out. That's a much bigger factor than the halving. So I don't really view the 4-year cycle as relevant. I still think liquidity is still relevant. I think the performance of precious metals and AI are relevant because obviously precious metals compete with Bitcoin on kind of the hard money front. So if those are rising a ton, it challenges Bitcoin in terms of competition. But then also tech stocks kind of challenge Bitcoin because Bitcoin is tech to some degree. So when you have kind of that fastest horse being AI, that also challenges Bitcoin. But at the end of the day, it's I think the 4-year cycle is less relevant, and it's really just about the usefulness of the network and the network effects that the system still has.
For years, investors assumed halvings were the dominant force driving price appreciation. But Bitcoin's annual issuance has now fallen below 1%. Compared to previous cycles, the amount of new Bitcoin entering the market every day is relatively insignificant. What matters far more is whether long-term holders choose to sell and how much new capital is available to absorb that supply. When early adopters who accumulated massive positions years ago decide to take profits, they can introduce far more Bitcoin to the market than miners produce over extended periods of time. That's why Bitcoin can experience significant price pressure even during periods when issuance is at historic lows. At the same time, Bitcoin is facing competition it never had to deal with during earlier cycles. AI companies have become the new destination for speculative capital. drawing attention away from digital assets. Meanwhile, the broader crypto market continues to work through years of excesses, failed narratives, and projects struggling to demonstrate real-world value. Yet Alden believes that this cleansing process may ultimately strengthen Bitcoin, as capital exits weaker projects and concentrates around assets with proven utility. Bitcoin and stablecoins stand to emerge as some of the strongest survivors. But Bitcoin's long-term future isn't just about price. It's also about what separates it from every other digital asset. And that brings us to one of the most important discussions in the entire interview.
One is that a lot of times you'll see headlines like the treasury seizes crypto, and people are like, look, they seized Bitcoin. And it's like, well, no, they said crypto. So a lot of times, I mean, that's kind of the risk of stable coins, is that especially stable coins can just be, they're a centralized issuer. So you can just go to the centralized issuer and say, hey, freeze these tokens. We've identified that, these are held by Iran or North Korea or whatever, and they can be frozen. Bitcoin, while it, around the margins, it can be taken. I mean, if you find a way to get someone's private keys, if someone stores their private keys online, or you're able to enter their place and take them, you can seize Bitcoin. But much like seizing a nation's gold or an individual's, gold, there's a cost of doing that. Either war in terms of a country or arrest or intrusion as far as an individual. Without the private keys, you can't get someone's Bitcoin. And some of the headlines, I think, confuse that for some people that aren't kind of just well versed on how the cryptography works and how the system works. And there is a difference between how Bitcoin, potentially can be seized versus how stablecoins and certain other cryptos can be seized. There was some evidence that Iran did turn to, Bitcoin payments. The question is, once they get the payments, what can they do with the Bitcoin? They can't just go on to Coinbase and say, hey, we're Iran. We want to go ahead and sell our Bitcoin for dollars. That's where that off ramp runs into issues. Now, Bitcoin is a global market, and it's not just like it's not like a stock where it might trade primarily on one exchange. Bitcoin is this decentralized thing that can trade on multiple exchanges. There are gradual ways that Iran can offload, their Bitcoin for other types of value, but there are frictions with it. Generally speaking, the bigger the network gets and the more trading hubs there are for it, the easier it gets to offload it, right? So the less kind of dollar centric it becomes, it'd be easier for regimes like that to offload it. But at the current time, I mean, I think that they have to be mindful of size, that they can offload some, but they can't just, get any amount of Bitcoin that they can and then just turn around and get dollars or yuan or gold for it easily.
How far do you think that the strategy that the US government is pursuing since a few years now of saying no to CBDC, but yes to stablecoin and kind of using that as a, well, what I call this a Trojan horse, like to CBDC in some form, to export the dollar on a global basis and to create infrastructure around this in order to also, on the other side, still create more demand for US treasuries through like the creation of the synthetic dollar. Did you like have some thoughts about this, or like how do you see this play out in general?
Yeah, I'm bullish on stablecoins. I've been bullish since several years ago. The market cap was like 30 billion, and now it's 300 billion round numbers. And I think eventually that they'll get into the over a trillion, maybe eventually into the multiple trillions. So I think that there's a lot of demand there. The ironic thing is that the U.S. doesn't really have to do much. They just have to not stop it. So the U.S. could, if they wanted to, kill most dollar stablecoins by saying, hey, if you issue a stablecoin, you're sanctioned. We don't want stablecoins. So they could do that, but simply by not doing that, there's a growth of stablecoin demand that is pretty organic. If you kind of look at the world, I mean, Africa has something like 40 currencies. Latin America has something like 30 currencies. There's plenty of currencies in Southeast Asia. All of these are frictions. All of these are border frictions. And stablecoins are a very efficient way to transmit value and to hold short-term value, assuming you're not a sanctioned entity, assuming you're not in Iran or North Korea, where like the U.S. And the stablecoin issuers can shut you off from it. If you're just someone in Argentina or someone in Nigeria or someone in Malaysia, they're a very effective tool to access a less inflationary currency than generally their local currency, and to pretty seamlessly store and transmit near-term value. It does get debased over time. You're basically holding dollars without yield. So you're holding something that the supply of it is growing by 7% a year, and you're not getting paid. The stablecoin issuer is getting paid. Again, we have to keep numbers in mind. So if we go from, let's say, 300 billion in market cap to 1.3 trillion, so let's say we add a trillion in market cap, that'll take time. And that's 6 months of U.S. deficits. That's 6 months of treasury issuance. So the sheer numbers of how many treasuries are out there, how many treasuries are going to continue coming to market versus stablecoin demand, it's a relevant factor, but it's not as though it's a magic fix for the fiscal dominance that the U.S. finds itself in. And the major cost is that people that choose to hold stablecoins for more than just working capital are getting debased. I mean, again, they're holding something that grows in supply by, dollars grow by 7% a year on average, and they're not getting paid a yield in the way that if they held treasuries directly. And of course, they're not holding something that's kind of dilution resistant like gold or Bitcoin or high quality equities or real estate.
One of the most fascinating implications of Alden's thesis is what it tells us about Bitcoin's future. If this cycle has been defined by OG holders distributing coins into unprecedented institutional demand, then eventually that process reaches a natural endpoint. Every Bitcoin sold by an early adopter is ultimately being transferred into stronger hands that have different incentives, different time horizons, and significantly larger pools of capital. ETF providers, corporate treasuries, sovereign entities, pension funds, and long-term institutional investors are not necessarily trading Bitcoin the same way early retail adopters did. They're accumulating strategic positions, and that may explain why this cycle has felt so unusual. Instead of a simple supply shock driven by the halving, the market has been processing years of accumulated profits held by some of Bitcoin's oldest investors. Numerous reports throughout the cycle have highlighted significant movements from dormant wallets and early whale addresses. Every time Bitcoin pushed higher, another wave of long-term holders appeared willing to sell into strength. While many investors interpreted that as weakness, Alden's framework suggests it may actually be part of Bitcoin's maturation process. The market has essentially been conducting a massive ownership transfer. The good news for long-term bulls is that this process cannot continue forever. Eventually, the pool of OG sellers shrinks. Coins that have been dormant for years become redistributed. Institutions continue absorbing supply. New treasury companies continue accumulating Bitcoin. Sovereign interest continues growing. And once the market no longer has to digest such large waves of legacy selling pressure, Bitcoin's supply dynamics could begin looking very different. That's why the most important takeaway from this interview isn't that the 4-year cycle is dead. It's that Bitcoin may be transitioning into a new phase where liquidity, adoption, institutional demand, and ownership distribution matter far more than the calendar. The next great Bitcoin bull market may not be driven by a halving. It may be driven by the simple reality that the sellers who have been suppressing upside for years have finally run out of coins to sell. And if that happens, the explosive gains that Bitcoin investors became accustomed to in previous cycles could return not just for Bitcoin itself, but potentially for the broader crypto market that tends to follow in its wake. But what do you think? Has OG selling been the hidden force behind Bitcoin's underwhelming cycle, or do you still believe the traditional 4-year cycle remains intact? Let us know in the comments below. If you enjoyed this video, make sure to hit the like button, subscribe to the channel, and turn on notifications so you never miss our future market analysis. Thanks for watching, and we'll see you in the next video.